Most investors are terrified of high interest rates. Warren Buffett is not. In fact, right now, with rates at their highest levels in 15 years, Berkshire Hathaway is generating approximately $16 billion a year in interest income on its $330 billion cash position alone. That is more than Berkshire earned from its entire insurance business in most years of the previous decade. While everyone else is worried about what the Federal Reserve is doing to their portfolio, Buffett has structured Berkshire so that rising rates are not a threat, they are a tailwind. In this video, I'm going to walk you through exactly what Buffett thinks about the Federal Reserve, interest rates, and monetary policy, drawn from 60 years of shareholder letters, annual meetings, and public interviews. His view is more nuanced and more counterintuitive than almost anything you'll hear in financial media. Insight 3 is the one that most investors completely miss, and it explains why Buffett's businesses perform differently across rate cycles than almost every other major investment portfolio. Stay with me. Let me start with something that surprises most people when they first hear it. Warren Buffett almost never talks about the Federal Reserve in the way financial media expects him to. He does not predict rate movements. He does not position his portfolio based on what he thinks the Fed will do next. He does not adjust his holdings based on whether rates are rising or falling. He has said explicitly that if you gave him the next 12 months of Fed decisions in advance, he would not change a single investment decision. That sounds like an extraordinary claim, but it reflects something fundamental about how Buffett thinks about interest rates versus how most investors think about them. For most investors, interest rates are a primary signal, a factor that drives which assets to hold and which to sell. When rates rise, sell bonds by this sector. When rates fall, rotate there. The entire financial advisory industry is built around this kind of rate-reactive positioning. Buffett's framework is different. He thinks of interest rates the way a physicist thinks of gravity, as a background force that affects the value of every asset, not as a trading signal to react to. His specific view: interest rates are the most important variable in finance. They determine the present value of every future cash flow, which means they affect the price of every asset simultaneously. But because nobody can reliably predict what rates will do, trying to position around rate predictions is a form of speculation that most investors mistake for strategy. What he does instead is build businesses that perform across rate environments, and manage his portfolio so that rising rates are as likely to help as to hurt. Here are the 5 insights that explain exactly how he does it. Interest rates are gravity, they pull all asset values down or up. Buffett's view. Buffett has used the gravity metaphor repeatedly across his shareholder letters and annual meetings. His version: interest rates act on asset values exactly the way gravity acts on physical objects. When rates are very low, like they were from 2009 to 2021, gravity is weak. Asset prices float upward easily. Stocks, real estate, private equity, and bonds all appreciate because the discount rate applied to future cash flows is minimal. When rates rise, as they have since 2022, gravity strengthens. The same future cash flows are now worth less in present value terms. Every asset class is affected simultaneously. There is no sector or asset type that is genuinely immune from the gravitational pull of higher rates. Why it matters. This framework explains something that confuses most investors. Why did virtually every asset class fall simultaneously in 2022? Stocks fell. Bonds fell. Real estate fell. Private equity fell. Crypto fell. The usual diversification logic: when one asset falls, another rises, failed completely. The answer is the gravity model. When rates rise sharply, the gravitational pull strengthens on everything simultaneously. There is no escape. Diversification across asset classes does not help when the primary driver of all valuations shifts at once. Buffett understood this dynamic long before 2022, which is why he did not expect diversification to protect him from rate risk. He structured his businesses to perform despite it. What you do when evaluating any investment: ask, how sensitive is this asset's valuation to changes in the discount rate? Assets with cash flows concentrated far in the future, long-duration bonds, early-stage growth companies, infrastructure, are most sensitive to rate changes. Assets with cash flows today, consumer staples, insurance, railroads, are least sensitive. This is not a trading rule. It is a framework for understanding why your portfolio behaved the way it did in any given rate environment. Insight 2 is about what Buffett specifically does when rates are high, and why his current cash position is not what most analysts think it is. High rates are an opportunity. Cash becomes a weapon, again, Buffett's view. From 2009 to 2021, Buffett faced a problem that most investors did not appreciate. Cash was essentially worthless as a holding. Short-term treasury bills were yielding near zero. Holding $100 billion in cash cost Berkshire billions in opportunity cost every year. The insurance float that Berkshire generates, typically $150 to $200 billion in policyholder premiums held before claims are paid, was generating almost nothing. Then rates rose, and overnight, Berkshire's cash position became one of the highest returning assets in the portfolio. At current rates, $330 billion in short-term treasuries generates approximately $16 billion per year, with zero credit risk and immediate liquidity. Buffett described this shift in his 2023 shareholder letter with characteristic understatement. He noted that fixed income investments had become genuinely attractive for the first time in many years. Why it matters. Most analysts look at Berkshire's $330 billion cash position and see excessive caution. A manager who cannot find anything to buy. Buffett sees it differently. That cash is earning 5% risk-free. For him to deploy it into equities, the expected return from stocks must be meaningfully higher than 5%, which requires either lower stock prices, higher earnings, or both. The high-rate environment has not made him more cautious about equities. It has simply raised the hurdle rate for deploying cash into equities. The cash is no longer dead money. It is an active, earning position that requires a compelling alternative before it gets moved. What you do. If you are currently holding cash or short-term fixed income at 5%, you are not on the sidelines. You are holding a real earning asset. Before deploying that cash into any equity or alternative investment, calculate the expected annual return on that investment and make sure it meaningfully exceeds 5%. If it does not, the cash may be your best position right now. That is not pessimism. That is Buffett's actual framework. Insight 3 is the one almost nobody discusses. The specific relationship between interest rates and Berkshire's insurance business that makes Buffett structurally different from every other major investor. The insurance float, why Buffett profits when others pay for rates. The insight most people miss, the peak. To understand why Buffett is structurally different from other investors in a high-rate environment, you need to understand how insurance float works. When someone pays an insurance premium to Geico, to General Re, to any of Berkshire's insurance subsidiaries, that money sits with Berkshire until a claim is paid. The time between receiving the premium and paying the claim can be months or years. During that time, Berkshire invests the money. This pool of investable premiums is called float. Berkshire's float is currently approximately $169 billion. It is money that belongs to policyholders, but that Berkshire controls and invests. Here is the critical point. Berkshire pays essentially no interest on this float. Policyholders do not receive interest on their premiums. They receive insurance coverage, which means Berkshire is borrowing approximately $169 billion at a cost approaching zero. Why this makes Buffett unique in a high-rate world. Most businesses and individuals who borrow money in a high-rate environment face rising costs. A company with floating-rate debt sees its interest expense rise when rates rise. A homeowner with an adjustable mortgage pays more. A private equity fund with leveraged buyouts faces margin compression. Berkshire faces the opposite. Its primary source of investable capital, the insurance float, costs essentially nothing regardless of interest rates. And the return on that capital, invested in treasury bills and short-term instruments, rises when rates rise. When rates were near zero, Berkshire earned almost nothing on $160 billion of float. Today, at current rates, that same float generates billions in annual investment income, at no additional cost. This is the structural advantage most analysts miss when they look at Berkshire's rate sensitivity. It is not rate neutral. It is actively rate positive. Higher rates are a genuine tailwind for Berkshire's core economics in a way that is true for almost no other large company. What this teaches. Buffett has spent 60 years building a business that is not just resilient to rate changes, but that benefits from them through the insurance float mechanism. The lesson for individual investors is not to replicate float. You cannot. The lesson is to look for businesses that have structural advantages in rate environments that hurt their competitors. Those businesses are rare. When you find them, the rate cycle becomes an opportunity rather than a threat. Insight 4 is about how Buffett reads Federal Reserve communications and why he pays attention to something very different from what financial media focuses on. How Buffett reads the Fed. Ignore the forecasts, watch the data. Buffett's view on Fed communication. Every Fed meeting generates an enormous amount of financial media commentary. Analysts parse every word of the chairman's statement. Markets move on punctuation changes. Entire trading strategies are built around Fed meeting dates. Buffett ignores almost all of it. He has said repeatedly that he has never made an investment decision based on a macroeconomic forecast, including a forecast of Federal Reserve policy. He does not know what the Fed will do next. He does not believe anyone else reliably knows either. And he has no interest in making investment decisions based on something he considers fundamentally unpredictable. What he actually watches. What Buffett does pay attention to is the current level of interest rates relative to the earnings yield of businesses he is evaluating. His framework: if the earnings yield of a business, the inverse of its P/E ratio, is meaningfully higher than the risk-free rate, the business offers genuine value. If the earnings yield is close to or below the risk-free rate, you are not being compensated for the risk of owning equities versus simply holding treasury bills. At current rates, a business trading at 20 times earnings has an earnings yield of 5%, exactly equal to the risk-free rate. That means you are taking equity risk for zero additional expected return. Buffett considers this genuinely unattractive, which is a primary reason he has been selling rather than buying broadly across his equity portfolio. He is not reacting to the Federal. He is reading the relationship between current rates and current equity valuations and adjusting accordingly. What you do: stop watching Fed meeting coverage as a trading signal. Start applying Buffett's earnings yield comparison instead. For any stock you own or are considering, calculate the earnings yield, earnings per share divided by price. Compare it to the current 10-year Treasury yield. If the earnings yield is not meaningfully higher than the risk-free rate, you need a specific reason, exceptional growth, pricing power, moat, to justify the premium you are paying for equity risk. Curiosity gap. And the final insight, Insight 5, is Buffett's long view on the Fed itself. And it is more optimistic than almost anything you will hear from financial commentators right now. The long view: Buffett's actual bet on America, not the Fed, the fundamental position. Buffett has navigated 12 Federal Reserve rate cycles since taking control of Berkshire in 1965. He has seen rates at 20% in 1981. He has seen rates at near zero for a decade. He has seen rapid rate rises and rapid rate cuts. He has seen inflation at 13% and inflation at 1%. Through all of it, his fundamental investment thesis has remained unchanged. American businesses, compounding their earnings over decades, will be worth dramatically more in the future than they are today. This belief is not naive. It is anchored in 100 years of economic history showing that despite wars, depressions, financial crises, inflation spikes, and political dysfunction, the productive capacity of American enterprise has grown every generation without exception. What he thinks about the current Fed environment. Buffett's publicly stated view on the current rate environment is characteristically calm. He has noted that current rates, while elevated relative to the post-2008 era, are not historically extreme. The 1981 peak of 20% was genuinely punishing. Rates at 5% are simply a return to something closer to historical normal. He has also noted that the Federal Reserve, whatever its imperfections, exists to prevent the kind of catastrophic monetary failures that destroyed economies in the 1930s. He trusts the institutional framework, not because he thinks the Fed always gets it right, but because the alternative, which is monetary chaos, is dramatically worse. His bet, ultimately, is not on the Federal. It is on American businesses and the American economy. And that bet has paid off across every rate environment of the last 60 years. What you take from this: the current rate environment will change. It always does. Rates that are high today will eventually fall. Rates that are low will eventually rise. The investors who try to time those transitions almost always get it wrong. The investors who own wonderful businesses with pricing power, durable competitive advantages, and genuine earnings, and hold them through rate cycles without reacting to each Fed meeting, capture the full compounding of those businesses over decades. That is Buffett's strategy. It has not changed in 60 years, and no Federal Reserve decision has ever given him a reason to change it. 5 insights, 1 framework, applied to the most debated topic in financial markets right now. Let's bring it together. Insight 1. Interest rates are gravity. They affect the value of every asset simultaneously. There is no sector that is immune. Understanding this prevents the illusion that diversification protects against rate risk. Insight 2. High rates make cash a weapon. Berkshire's $330 billion earns $16 billion per year risk-free. That raises the hurdle for deploying capital into equities, which is exactly why Buffett has been a net seller of stocks. Insight 3. The insurance float is the structural advantage most people miss. $169 billion borrowed at near zero cost, invested at current risk-free rates. This makes Berkshire rate positive in a way almost no other large company is. Insight 4. Ignore the Fed forecasts. Watch the earnings yield comparison. If a stock's earnings yield is not meaningfully above the risk-free rate, you are not being compensated for equity risk. That is Buffett's actual decision framework. Insight 5. The bet is not on the Federal. It is on American businesses compounding over decades. That bet has paid off through 12 rate cycles. There is no reason to expect the 13th to be different. Here is the bottom line. The financial media will spend enormous energy on every Federal Reserve meeting for the rest of this year. Rate predictions, dot plots, hawkish versus dovish, tapering timelines. Buffett will not change a single investment decision based on any of it. His businesses will keep generating earnings. His float will keep generating income. His cash will keep earning risk-free returns until something more compelling appears. That is the system, and it does not require a Fed prediction to function. The next video this week covers one of the most searched topics in investing right now, artificial intelligence stocks, and what Buffett's framework says about whether the AI boom is a genuine opportunity or the most expensive consensus trade in a generation. That video is right here.